New investors tend to make the same really bad decisions. I know, I've made them too. This video is going to ensure you don't do the same stupid stuff, and I'll explain mistake number 1 straight away. Let's say you're saving for something big within the next couple of years, a house deposit, tuition, whatever. And you're thinking, maybe I'll invest to boost my balance. Something low risk, right? The big names, Microsoft, Nvidia, Apple. They're the 3 largest US companies right now. They seem like safe bets. I own 2 of those. But let's look at the last 12 months. If you bought Microsoft here, 9 months later, you'd be down 24%. You'd only be up 2% now. Nvidia here, you're down 35% within 5 months and still down 3% today. Apple here, you're down 33% after 4 months and you're still down 22% today. In the stock market, short term, there are no safe bets. If your financial goal has a deadline within the next year or 2, the stock market is probably not for you. Honestly, and I'll lose some views for saying this, you'd be better served stopping this video right now. Go watch someone like Graham Stephan. Cut your spending, get an extra weekend warehouse job, sell some stuff on eBay. That's all guaranteed income. The stock market isn't. But if you're playing the long game, where short-term drops don't destroy your life plans, then perfect. This video is for you. So let's get into mistake number 2. The gains you see from certain stocks can look very appealing. Robinhood, SoFi, Palantir, they're all up over 100% just in the last 12 months. Sounds great, right? But let's zoom out. In the 12 months up to the 9th of June, 64 stocks out of the US's top 500 achieved 50% gains or more. Not bad, right? I don't think so. It's just over 12% of stocks. So with some diligent research, you just might be able to find one of those opportunities. It's totally possible. But you don't really just buy one stock. You create a portfolio, don't you? So what happens then? Well, let's be generous and say because of your diligent research, the odds of you picking a stock that achieves 50% or more gains in a year is 1 in 3, which would probably make you one of the world's best investors, but let's ignore that for now. Even with all that stacked in your favour, the chances of you picking 5 stocks to fill your portfolio, which all beat 50% gains over the year, would be 0.39%. That's significantly worse odds than you can get for South Korea winning the next World Cup. This isn't to kill your enthusiasm. You can find great stocks even as a beginner, but you've got to stay realistic. Not every stock you pick will win big. Expecting 40, 50, 60% portfolio returns every year, that's not a strategy. That's a fantasy. Aim to beat the market and then just treat anything above that as a bonus. And also, when you get started, you open up your Trading 212 account or whatever you use, you deposit some cash, just take a deep breath and slow down. You don't need to create a fully fledged portfolio on day 1. In fact, you shouldn't. If you do, you'll probably not be buying the stocks at the best times, or even more likely, you're just not buying the right stocks. Take your time, find the businesses you like, and then invest in them when they're trading at a fair or ideally a low price. But what do I do with my money in the meantime, I hear you ask? Well, it's quite simple, actually. Just put it in an index fund. I have a chunk of my portfolio in the Nasdaq 100, but you can go even lower risk and put it in the S&P 500 or even a global index. That way, you're still involved in the market. You don't get that FOMO that comes when you're just holding cash. And you can take your time to spot the right investments at the right time, sell your index fund, buy the stock, and build up a portfolio that you're truly confident in. Don't frantically buy loads of stocks on day 1. And if you want to feel confident in your investments, you need to avoid this very common next mistake. Diversification is one of the buzzwords in investing. Pick a wide range of stocks across a wide range of industries and lower your risk. That's great advice if you're a pension fund manager, but for individual investors, there's not so much. Let's actually take a look at a portfolio of 20 stocks. Just looking at that is overwhelming, isn't it? Good luck tracking all of those businesses properly. But more importantly, once you get down to your 18th, 19th, 20th best idea, are they really going to be good ideas anymore? Or are you now just forcing stocks in to artificially hit some kind of diversification target? That kind of diversification, it doesn't protect you. It just waters down your best ideas. Instead, focus on a handful of individual stocks, companies you know, companies you love, and companies you're confident in. Keep it less than 10. In your first year, 5 or 6 is plenty. And if you're worried about risk, which is totally fair enough, Keep a chunk of your money in an index fund. That gives you instant diversification across hundreds of stocks, no effort required, and it frees you up to concentrate on finding just a few great individual investments. There's a theme building here, isn't there? Simplicity. When you're starting out, the more you simplify things so you can focus on what's really important, the more you tilt the odds in your favour. The next mistake, it does the opposite. It tilts the odds against you, and I'll prove it. In the last 12 months up to the 11th of June, just 28% of the top 5,000 largest public US companies achieved a return above 20%. But if we shrink that down and just look at the top 500 stocks instead, 46% of those achieved a 20% return or higher. This isn't talked about enough in my view, because most books you read or most videos you watch, they focus in on those hidden gems, the small caps that 10x over time, because those are the exciting stories. But the actual reality is that the larger, better known stocks usually outperform the smaller caps. So focusing on just the top 500 stocks is another way to help tilt the odds in your favour. It helps simplify your strategy. You don't need to find hidden gems. There are loads of opportunities for massive returns in large cap stocks. It's lower risk and they're easier to research. It's a win-win. Here's another way to tilt the odds in your favour by missing this mistake, and it's also rarely talked about. In January, I sold all my Adobe shares and I bought Uber. Both are high growth, financially strong businesses. But there's another thing they have in common, which is absolutely nothing to do with their financials. I'm a customer of both of them. I've used Adobe products since 2006 with Photoshop CS2, and I still use them today. For almost all that time, I think they've offered best-in-class creative software. But for the first time in 19 years, I'm starting to get frustrated with that product because I don't think they're adapting quickly enough to AI. Now, it's not in the financials yet, but I'm no longer confident that they'll stay ahead. And that, combined with it being slightly overvalued, are the two reasons that I sold. The stock's down 7% since, but if they don't catch up soon, I actually think the next 5 years could be brutal for them. Being a customer gives you direct insight into the product quality. It's an insight that no financial report can offer. I spend hours every month using Adobe tools. I know that their implementation of AI should be better. When it is, if it is, I'll reconsider the stock. But until then, that industry is wide open to massive disruption. I know that not because of any Wall Street report, but because I'm a customer. Don't buy stocks whose products and services you don't use. It's a huge advantage. Now, I've mentioned that Uber purchase in my other videos. It's done all right. It's up 30% in 6 months, but I don't want you to think that that's typical. It's not. There is no magic formula to buying a stock at its very lowest point and then expecting a stock to just go up from the moment you buy it. It's just not realistic, no matter what anyone says. In fact, in the short term, it is much better to expect a drop than expect a gain. Be a pessimist, not a fool. Let's take that Uber example. I bought here at the start of January. Within a week, the stock was down 2%. A month later, and it was down again 3%. 3 months later, and it was down again. 30% now sounds like a good figure, but a month ago I was up 40%, so 30% kind of sucks. If you have a mindset of sunshine and endless stock gains, your morale will get crushed when that stock drops, and it will drop. To give you some perspective, when the market as a whole drops 20%, that's considered a market crash. The last one in the US was about 3 years ago. But in just the last 12 months, 361 stocks from the top 500 experienced a 20% drop at least at some point. That's 72% of stocks. For individual stocks, large drops are unavoidable. This is why it's so important to buy stocks you are confident in, not just random guesses. Because if these declines crush your mentality, you will make bad decisions. Expect significant drops. But once you start picking stocks that you're naturally confident in, you'll avoid a lot of these rookie mistakes. Like this next one, thinking that timing the market is important, but it's really not. So many people say that the market's too high or you should wait for the next dip. But when you're buying individual stocks, that is never, ever, ever the case. What matters is the business. Is it high quality? Is it trading at a low or fair valuation? When I bought Uber, the overall market was near record highs, but Uber itself was undervalued. I wasn't buying the market. I was buying one company. And whilst the market dipped, Uber went up. That's why timing the market is such a distraction, because it gets people focused on macro conditions rather than their actual business. If your investment depends on whether interest rates rise or fall by 0.5% over the next 6 months, then it's probably not a great investment anyway. A company can be overvalued during a market crash, and it can be undervalued even during market highs. Focus on the business, not on the headlines. When you're buying individual stocks, timing the market really does not matter. This next point is super important, because even if you do everything right and pick some amazing stocks, you can still completely ruin your gain potential if you make this mistake. Different countries offer different tax benefits for individual investors, and some are actually quite generous. So, as an example, in the UK, you can pay up to 20 grand every year into a stocks and shares ISA, and there are 0 capital gains on those investments. Other countries have similar schemes. There are a lot of nationalities that watch these videos, so I can't go through them all. But nowadays, you can just ask ChatGPT, what's the most tax efficient way for a British, American, French person to invest in stocks? And it'll tell you. Super easy. To hammer that point home, if you invested 20k into the S&P 500 through a tax-free ISA 10 years ago, your total today would be just over 62,000 tax-free. But outside of that ISA, you'd lose up to 9 grand to tax. Don't rush in. Figure out the most tax-efficient vehicle for your investments before you start investing. Now, this final point is all important, really. It's what I focus on a lot. You need to know exactly why you bought a stock. Let me show you what I mean. This is my free stock screener. Some of you already use it. It filters stocks based on different strategies. I focus on these two, the balanced risk and the lower risk strategies. Each one has very specific criteria a stock has to pass. The point is not to spot every single winning stock. If you try to do that, you'll probably lose. It's about narrowing the field to a small group of high quality businesses that are very likely to succeed. It doesn't matter if stocks outside of my parameters go up, as long as the stocks that I do choose go up as well. Palantir, for example, I wouldn't touch it. That business is great, but the valuation is just way too high. It is nowhere near the conditions I have on my investments. But if the price doubles next year, and it might, then great. Good for them. I still don't care, as long as my portfolio also does well. Now, you don't need to use my specific strategy. There are loads of different investing methods that work, which are different to mine. But find the one you're comfortable with, the one that you think makes sense, and focus in on that. Ignore everything else. Because when someone asks you why you invested, you want to be able to say, because the 5-year sales growth was 187%, the debt to equity was 0.3, the free cash flow was the second highest in the sector, the PE was 24 and the PEG was 0.8, and I use their products and I think they're the best in the industry. What you don't want to say is, saw it on Reddit. Follow a strategy. And if you are interested in the strategy I use to find great businesses at fair and low valuations, then watch this video next, where I show you exactly how I go about doing that.